Hello, everyone. Today on the Final Bar, I'm talking with Dale Pinkert from TradeGateHub.com. Happy Fed Day. It's Wednesday, July 27th. We'll talk about a rocky, crazy ride through this trading day, opening higher based on some strong tech earnings, really accelerating to the upside with the Powell press conference after the Fed meeting today. The Nasdaq finishing up over 4%. Does this change the big picture? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and very hot Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. Today was a very interesting day, to say the least. We talked at the beginning of this week, all of the potential catalysts we have for risk assets this week, a bunch of earnings, right? And, significant earnings like Alphabet, Microsoft after the close yesterday. As we were going live here now, we have Meta and Qualcomm and others that are reporting, and plenty others continue through the course of this week. Also, the Fed meeting today with a lot of movement, a lot of acceleration to the upside. So what's interesting is we have a lot of potential catalysts. What's not surprising to me is how the market has been rallying through this sort of Fed meeting day here, because that's what's happened pretty much with every Fed meeting in 2022. So you have this sort of conflict, right? Big rallies on Fed days, that's great. Overall, the bear trend continues to be confirmed, though. And after these rallies, they fizzled out very quickly before we roll over and continue this bear market phase. Is that another cycle, just yet another Fed meeting bounce and roll over? Is this the playbook that the tried and true playbook for 2022? Well, in short, that's going to work until it doesn't. Let's look at some of the evidence together and see what the charts can tell us about the acceleration off of the lows over the last month and the potential sustainability of this rally. We have great guests on the show. I'm excited to talk to Dale Pinkert here in a short while. Always does a great job just sort of taking a step back and looking at some changing trends in the world around us. Coming up this week, we are in the coming weeks. Tomorrow, we have Mish Schneider, host of Mish's Market Minute, here on StockCharts TV. Next week, on Tuesday the 2nd, Jonathan Krinsky from Baycrest Partners is going to join us. On Wednesday the 3rd, our mid-year market outlook called Charting the Second Half. We're going to do a really interesting job, I hope for you, sort of laying out some different market guideposts. Where do a series of experts, where do we see the S&P closing the year? What do we see for metals, hard assets versus soft assets? What about interest rates? What about Fed policy? And trying to just tease out some of the themes to be expected over the next 5 to 6 months. You can tune into that next Wednesday, the 3rd. It's airing at 9 a.m. Eastern. Let's continue on today's show talking about this market recap. As I mentioned, a crazy day with a lot of potential narratives. Certain days were sort of light on catalysts, and so we can focus in on one economic indicator or one company reporting earnings. Our cup runneth over this week with a lot of different things going on. At the end of the day, the market's does a pretty good job of aggregating all of that stuff and turning it into positioning, right? This is how investors are reacting in aggregate to all of the information that's out there. So let's look at what the markets actually did today. End of the day, the S&P having a pretty decent day, getting above 4,000 to up 2.6% to 4023, 4024. So the Nasdaq really leading the way higher, with the Nasdaq Composite and the Nasdaq 100 both finishing higher, over 4%. Mid caps and small caps up as well, but not as much as the S&P 500. Large cap index and the VIX is down below 24. It's actually around 23.2. We'll look at as many of those individual charts as we can here through the course of our market recap. Let's see what else happened today. We'll talk a little bit more about interest rates a little later in today's show in a segment called "Don't Fight the Fed." I'm sure with my guest Dale Pinkert, we might talk a little bit about the Fed meeting for sure, because that's top of mind for most investors today. But interest rates really coming down pretty significantly across the board here. The 10-year yield down to around 273 by the end of the day. The dollar rolling over is a big story today. Now, that strong dollar over the last 12 months has been a significant trend to focus on. You could argue that most of the other things we've been dealing with have been related to, if not caused by, that incredible strong uptrend of the dollar. If we would find some evidence that that trend is exhausted, if we see a weaker dollar from here, it's a very different environment than what we've seen so far in 2022, to be sure. Gold having a rare but very impressive update, only up 1% using the GLD, but we'll take it on in an ETF that's been struggling for sure. Silver up about 2.5% using the SLV ETF, and commodities as a whole having a pretty decent day. Energy stocks up a couple percent using the XLE as well. Cryptocurrencies all moving to the upside, sort of a risk on measurement, just like stocks, particularly technology stocks rallied. See a similar move after the press conference, or during the press conference, really, with Bitcoin, Ether, and all the other major coins that we track, all up pretty significantly. Ether finished the day up almost 10% to around 1,600, and Bitcoin has put 20,000 maybe in the rearview mirror a little more distantly, reaching 23,000 a little bit ago, easing off a little bit from those levels, but certainly cryptocurrencies having a pretty decent up day after struggling and been in what I call the wilderness for quite some time here, sort of trying to find its footing. Let's look at a chart of the S&P 500 and see how today's rally fits into the big picture. So getting above 4,000 is significant. I'll tell you why. On Thursday, we rallied above the, really earlier that week, last week, we got above the 50-day moving average for the first time since April. That was pretty meaningful. We then rallied up to 4,000, which number one is a big round number. Number two is a 50% retracement. If you take September 2020 to January 2022, it's about half of the way is right there, right around 4,000. That's where we hit out on a closing basis last Thursday. And then Friday kind of came off of there. And then the next 2 days pulling back. So yesterday we closed right at the 50-day moving average. That set us up today to bounce off of the 50-day and all of a sudden close above 4,000 here. So anytime you have a significant resistance level, of which I think 4,000 is a good one, it's all about what we do leading up to that level, which is we establish that once again as a level of resistance. We pulled back. Then the other one is what happens as we get through that level. Now we've closed above it, which is meaningful. Do we have follow through? And I think that's where the remainder of this week could be really key. We have usually rallied on Fed Day and around Fed Day. If you look back through 2022, that has been part of these bear market rallies and certainly bounces have been pretty much every time the Fed's meeting. There's this great rally around the press conference time as there's this renewed optimism that everything's kind of going to be fine and we've got it and we've got it covered. At the end of the day, it's all about once that news is digested, what happens next. And what's happened in previous bear market rallies is we've rallied quite a bit, a lot of times fizzling out before we're able to really establish any sort of foothold above previous resistance levels or clear resistance levels. And then we sort of revert and continue this rotation to the downside. So how could this time be different? Well, number one, we'd have to continue to move beyond 4,000, because if you look on a percentage return basis, we're kind of where the average bear market rally has been. We're kind of done it, right? This is sort of what's happened if you look back through the course of this year. So getting meaningfully above 4,000 would make this all of a sudden have a very different look and feel than the previous bear market rallies we've seen so far this year. The question is what actually propels us higher, and that's where I want to just look a little bit at the leadership. So if you look today, it's the FANG sectors that are doing so well, right? XLK, technology, communication services, consumer discretionary, all up 3-4+%. That's what's allowing the benchmarks to rally so significantly, right? The benchmarks are really growth-oriented benchmarks for the most part, really drawing on the strength of the mega cap names, and those, most of them, happen to be reporting earnings this week. So yesterday you had Microsoft and Alphabet after the close, moving higher today, although they were selling off, if I remember right, in the after hours yesterday, recovering this morning and started to rally up a little bit. Do they maintain that strength, not just into today, but after today? Today we have Meta, which we'll look at here in a while if we can. Tomorrow, Apple and Amazon as well. Do we see further support from those earnings releases, sort of validating this, difficult quarter, sort of negative short-term numbers, but less negative, more optimistic looking down the road a little more improved guidance. If we continue to get that sort of feel from some of these big tech and communications names, consumer names, that certainly could fuel this further rise. We talked yesterday, if I remember right, or maybe on Monday's show, talking about that Sam Stovall sector rotation model. And if you missed it, if you go to charts and tools, go to where it says sector perf chart, which is our performance chart. Right down here is the sector rotation model to which I refer. When the market bottoms, which is this idealized orange cycle, and starts to improve, we tend to see leadership from two particular sectors, technology and discretionary. If you look back through a bunch of bear market phases and how those bear markets ended, it was almost all of the time driven by these growth-oriented sectors. So what I'm seeing so far this week from some of those fangy type of sectors like technology, communication services, certainly appearing to line up with that. Now, the challenge with some of those names, and just to finish off our market recap, we can look at Microsoft. The challenge with these names, nice bounce, right? Microsoft up over 6% today. Pretty decent day. This is after yesterday closing down, trading down to 250. Today, we're about 20 points higher, moving higher here. But we still haven't broken above our previous resistance level. And this is the challenge I see for this market as we head into the break. Some of the names like Microsoft have had decent rallies, but we still haven't broken above previous resistance. The RSI is still below 60. It's not really validating that bull market phase. So I would argue you still have more to prove from this technology space, some of the FANG types of names, to validate the fact that this is not just an exhausted bear market rally, but the beginning of something more meaningful. Let's take a quick commercial break. We'll be back with today's guest, Dale Pinkert. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close. Some days we are struggling to find things to talk about. I feel like today we could have an 8-hour show and we would not struggle to fit in all the different charts we could show. That is the nature of the market environment. It goes in cycles, and there are days like today where there are a lot of narratives to try to pick apart. The best thing we can do is try to help you understand those. And we have a great guest here in a few moments to help us do that, Dale Pinkert. A couple quick announcements before I bring on Dale. First off, we welcome your questions. We had a mailbag segment yesterday, which is a lot of fun. We talked about a couple of really key issues in the technical toolkit and how to analyze industries and stocks a little more effectively. We welcome your further questions, and we're going to do another mailbag segment at the end of this week on Friday's show. We love to feature one of yours live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv. We're on YouTube. Give us a follow there, subscribe to our YouTube channel, and let us know if you have questions in the comments below the video you're watching. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Great guest perspectives like Dale Pinkert, many, many others helping us draw on their years of experience in the markets. Also, special events like our mid-year market outlook coming up, the pitch, our next episode coming up in the next couple of weeks as well. All of that is for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Dale Pinkert. Dale's the head of trader development at TradeGateHub.com. Dale's been a frequent guest on the show. It's good to see you, Dale. Welcome back.
What a perfect day to be with you, David. Thank you for having me. And I had that option for Fed Day, and I said, how come no one took Fed Day? That's, when you could hear the ice crack. So
I was going to say, you bravely came on a busy day in the markets, but obviously all eyes have been on the Fed. There's a lot to digest as the markets rallied so significantly. Talk us through. We have a chart of the Aussie dollar up here to start off with. What are you seeing? What are you thinking here?
Okay, well, I wanted to talk about commodity currencies because a lot of people are saying the commodity bull is dead. I don't think the commodity bull is dead. And, there's a thing called relative strength. It's no new invention, goes back to Investors Business Daily. And this low that we had in March at the low in COVID, March of 2020, was a low in Aussie. So if you looked at the dollar index took out its high, its COVID high. Okay. And the euro took out its COVID low. If you were looking at a euro monthly, you'd be seeing new lows under the COVID low. So why be a hero? And I've had a few attempts at finding a turn in the dollar. And when you look at Aussie, it looks more corrective and only a retracement type of move. And this is a monthly chart. And if you include today's action, you have a reversal month to the upside. And it looks to me on a shorter term chart, like a daily, you have a breakout out of a falling wedge. So I wanted to show that I believe the commodity currencies could lead the way. It's probably going to take more in the euro to close back over 103.5 to get the market to embrace the euro. But I also wanted to show the Canadian. It's the inverse because they're paired differently. This is Aussie USD, and now this is USD CAD. So same type of scenario. If you go back to March of 2020, that was the high of USD CAD. And any technician would say that this action that we've had since the low in 2021 is choppy. There's nothing impulsive about it. It just chopped around and worked its oversold condition off more in time than price. So again, another reversal month with today's action. You know, I could see new lows. That 200-week moving average at 117 would be a viable target. And I think it's significant what's happening in the dollar, Dave, because if you go back and the tear you were talking about in the dollar was pretty tightly correlated to risk. And as you know, with the war and what's happening in Europe and the fear, the risk aversion. So if we have a turn in the dollar, I think that we're going to have the you could be long everything market for a while.
And it's sort of been the opposite for a while now, right? It's been it's been long nothing period for a stretch here. Talk about a change of character. I often try to highlight a change of character. We could be at one of those potential moves, apparently, right?
Yeah, great. You know, I've seen many inflection points on big days like Fed days and NFPs, and now it's inflation numbers that you see a lot of reversals occurring. So you know, of course, a lot of bulls are going to say, well, you know, Dale, we have to at least take out that prior high of 105 before we can say that the trend has changed in the dollar. And you know, I believe that they're correct, but I'll add to my dollar short position down there instead of missing the first 10% of the move.
So obviously a lot of movement in the equity markets today with the S&P and the Nasdaq, especially, you know, pushing to the upside. We've now gotten back above the 4,000 level and breaking down below that back in May. I remember that was when we changed that first digit on the S&P. It's a pretty big deal. And I know a lot of people sort of revisit it. Have you seen enough with the strength in stocks and maybe following through today to feel that this is now setting up in an optimistic scenario, or is this still more feeling like a bear market rally? How are you differentiating those in this environment?
Well, I've been talking about since we bottomed on the solstice right around the 21st. That's a Gann thing, that perhaps we're going to have a summer rally. And, you know, back then it was a theory. You only know if you have a low in a rearview mirror. But, you know, there's not a lot of euphoria today, despite the market's up. The market's still very underowned, skeptical. Who wanted to buy the market in front of the Fed? Not most people. I believe the 4,200 is going to be a big battleground, and that the bears will rationalize it's still a bear market rally until we start closing above 4,200. And then you have to be open to the potential for new highs in the S&P. So I think the Fed is going to welcome a weaker dollar, gives them a chance to tighten without the kind of damage that's being done with a strong dollar in emerging markets, David. And just in nominal terms, a weak dollar lifts all boats.
It's certainly been, and again, I mean that dollar. I know when I've talked to you and very happily come on your show, we've ended up talking about currencies, all these different components, all these different inputs that sort of relate to the broad market, broad market outlook. Just to finish off here with about 30 seconds, when you're looking at interest rates, right? Talk us through the 10-year yield and what happens to this chart going forward based on everything else we've gone through. Where are you looking here?
Well, you could see it plain as stage. It's draw a horizontal line at 2734, which is 273. Under that level, I think you're looking at 220 to 2%.
It's quite a reversal, right?
So the dollar could be losing its interest rate differential advantage with perhaps euro continuing and other central banks continuing to hike.
Dale, I'm so thankful that we got to talk to you today on a perfect day to sort of draw on your expertise and help us think about how all these different moving parts are related. I know for a lot of investors that can be a challenge. Good to see you. Stay safe, be well, and talk to you again soon, all right?
Glad to serve, my trading warrior brother. Thank you.
Take care, Dale.
All right.
That's Dale Pinkert. Dale is the head of trader development at TradeGateHub.com. Great job. If you think about when I talk with Dale, I'm often humbled by how he's able to think about how all these different parts are related. And talking with Dale reminds me of some of my favorite conversations with experienced traders, with strategists who really think about these intermarket relationships. Obviously, we're fortunate to have John Murphy as our chief technical analyst, who's done so much to sort of promote the concept of intermarket analysis, how to think about how all these things are related. On a Fed day, it is a good reminder. If anything that we were going through together, thinking about interest rates, dollar, other currency pairs like dollar, Aussie dollar, dollar Canada, the euro, the yen, other crosses, and obviously interest rates and other asset classes. If you're not familiar with some of those things, I would encourage you to dig into books by John Murphy and others that help you make those relationships. Let's continue this thought process going to our next segment, Don't Fight the Fed. When I was asking Dale at the end there, it's so easy, particularly when we're thinking about interest rates, particularly when we're thinking about Fed policy, even with stocks, to get locked into a particular perspective. And I am just as guilty of that as anyone. And it's so frustrating, really considering myself an expert in behavioral finance. That does not mean by any stretch that I'm immune to some of the challenging parts of it, which is you get drawn into a narrative, usually built around your positioning and how you are going about things. And then it's very hard to disconnect from that. It's very hard to get away from that narrative. What I would suggest to you, and what I would often and always recommend, is to focus on the data. The way that you release yourself from the shackles that could be a narrative that's no longer working is by focusing on the evidence. The charts will tell you when the narrative is no longer working as you expected, and hopefully gives you a way to manage risk along the way. So we've been talking about higher rates for quite some time. We've been talking during this, these last couple of years, the potential for rates to move higher. And I've been, surprised at times and certainly impressed by how much rates have gone higher, incredibly eclipsing the 2018 high, which seemed like this unrealistic, impossible goal when the 10 years back at 1.5%. Talking with Daly, talking about the potential for rates to move lower. And this is what I think you have to remember. Separating the long-term thesis from the short-term thesis. Could interest rates go lower down to 220 on the 10-year? Absolutely. That would actually make a lot of technical sense, because if you look at the Fibonacci retracements, take the high from 2018 and the low from 2020, 215, 216 is right about 38.2% of the way back down. So getting to about 220 would pretty much be a very poetic, very perfect sort of Fibonacci relationship, drawing down on that, that big run up that we saw in rates. Also would settle in right around the 200-day moving average, which is currently around 222. So that actually lines up pretty well with that. Same thing when you think of the chart of the S&P 500. I've mentioned before, I don't think we're done. I don't think we've seen the low of the year yet. However, there's a lot of year left, right? And 5 months left, which is basically what we have left. There are a lot of things that can happen, and you can make new lows and then make new swing highs all during the course of that period, with a lot of information in between. Thinking about what's happening right now in terms of the rally phase, I think a lot of times we probably spend too much time worrying about whether we label something a bear market rally or not. The real thing you should be doing, and I would encourage you to do it, is think about your time frame. What are you trying to do? What time frame? On which time frame are you trying to operate? Are you planning for decades down the road, or 10 years or 10 minutes, or somewhere in between? Once you figure that out, then think about what the charts are telling you about the environment between that period. I can see a scenario where the market certainly moves higher from here, and right around the Fed meeting is an absolute classic time for that to happen. And to be honest, if you look back at the previous Fed meetings, you can see these big spikes that tend to happen around the Fed meeting dates, because there tends to be a lot of optimism going into the meeting, because there's sort of this anticipation that things are going to improve. But especially during the press conference, more often than not, we've seen a rally in 2022 because of the commentary. If you listen to the language in the press conference, it's a lot of reinforcing the fact that things are going to be okay. You know, earlier and months ago, it was the willingness of the Fed to take action. Now it's, this is working. We've been taking action. We're going to continue. We'll do whatever it takes. And those words tend to calm down the market. But what's happened every time after that, if you look back in 2022, is that the market essentially has rallied a little bit and then rolled over. So the question is, where would you expect a rally to fizzle? I think that 4150 to 4200 level makes a lot of sense. And again, talking with Dale Pinkert, we sort of settled in. He sort of mentioned that level of 4200. That's a good one because it's a Fibonacci level that we've highlighted before. That would also put us in line with the May high. But I think one of the things that Dale mentioned I thought was really interesting is if we would get above 4200, then you'd have to acknowledge that things are different. That is the essence of what I call the line in the sand. I'm a big fan when you have a particular thesis. Overall, I've been structurally bearish on stocks, and I still remain that way, even with the bounce that we've seen here over the longer term. We talked about short-term strength, and I think that is absolutely the case. I wouldn't be surprised if we get more of a run, given what I saw, so far this week. However, I think that eventually the market will return to the downside. If and when we get above 4,200, we get above those swing highs, we do it in a meaningful way. You think about what would have to happen to different parts of the risk asset list to get to that point. That's going to be a pretty compelling rally. That would be my line in the sand. Over 4,200, I think you have to really consider whether you can label this a bear market rally and start to label it as more of a bottoming pattern and think about potential upside targets beyond that. Those are some of the things I would think about to in our segment, Don't Fight the Fed. And again, what's been true in 2022 is do not fight the Fed in the short term for sure. They are coming out with optimism and comforting words, and the market is loving it, and it's rallying, and we're seeing that again so far this week. We need to wrap today's show, folks, and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I showed charts of the S&P 500. I did not show a chart of the Nasdaq Composite yet, but I just wanted to show you an interesting pattern here. It's what we call an ascending triangle pattern, which is when you have a consistent resistance level and then an ascending support level, right? So higher lows and stable highs. That usually resolves to the upside, usually about 2/3 to 3/4 of the way through the pattern. That pretty much happened a couple of weeks ago when we broke above that ascending triangle pattern, basically initiating a buy signal based on that pattern, right? A bullish signal. We then pulled back to the 50-day moving average, closing inside the pattern yesterday, but today, all of a sudden, this looks like a rally and a retest before resumption to the upside. That actually measures back of the envelope around 13,000 for the Nasdaq Composite. It'd be a decent rise, another 1,000 points in the Nasdaq Composite if that measurement would play out. Chart number 2 is the Semiconductor ETF. We have some semiconductor earnings this week. Qualcomm, let's see, I'm looking at some tech names. We have Qualcomm today. We have Intel tomorrow, a couple others there. I'm trying to glance through too many tickers at once. We have a number of names in the sector, but especially in the semiconductor space as well. On semiconductor, I saw with a big move higher. The SMH has broken above a trend line, taking the March and the June high. We broke above that last week, pulled back, and now potentially reverting to the upside. The RSI is getting above 60, which is what I'm so interested in. Look at the PPO, though, and this is why I think this is a really interesting chart. The March rally, the June rally, and the current pattern all look really similar to me. That's why this felt very much like a bear market rally nearing its end. Let's see if we can get above 240, which would take us above that ultimate trend line. Finally, let's finish the show celebrating a stock with a decent move higher. Biggest gainer in the S&P today, Enphase energy in the technology sector, gapping above 220, holding above there certainly makes this an impressive chart with strong relative strengths. Folks, that's a wrap for the show. Thanks so much to Dale Pinkert from TradeGateHub.com joining us and sharing his perspective on a busy Fed day. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.